Welcome back to Real Estate Radio TV for a new interview. In today's interview, we have the honor and privilege to welcome Jeremy Gelb, Associate at Capital Markets within Thor Equities, a real estate private equity firm investing across many different type of assets as well as asset classes and different markets as well. Today's main topic is going to be around the growth of the life science sector as a real estate asset over the past couple of years. A lot of private equity firms getting involved into that sector. We're also going to talk about the current state of the industrial sector as well as the logistics sector, increase in private equity allocation from LPs as well as the European and US capital markets. Jeremy, how are you today?
I'm doing very well. Thank you for having me, Tudor.
It's a great pleasure. So, Jeremy, to start off, what I propose you is you kind of give us a small introduction about yourself, talk a little bit about your business background as well as your role within Thor Equities, and give us a brief overview of Thor Equities as a real estate equity player, the type of assets you're investing in, as well as the different information.
Yeah, absolutely, absolutely. So, like you mentioned, Thor Equities, we're a private equity real estate shop out of New York. We have offices in New York City, in London, and Mexico City, with satellite offices in San Francisco and Paris, Madrid. So, very global firm, and we touch on a lot of different geographies. My role at the firm is on the capital market side, so generally raising equity and debt for our deals. So, kind of overseeing all the geographies, but mainly focused on Europe and the US. Um, I've been with Thor for about 3 years now. Prior was at RXR Realty, so I spent the better half of a decade focused on office, and now in um, the my role at Thor Equities, focusing on a wide range of asset classes, which I'm sure we'll get into more as we go on. But just to take a step back and tell you more about Thor Equities. So Thor Equities was founded in 1986 by our chairman, Joe Sitt. Joe is still heavily involved in the real estate sector today. So the origins of the company, Joe made his money as a retailer. He started a brand of women's clothing called Ashley Stewart and grew the firm to about 380 stores globally. Um, After realizing that he could make more money as the landlord than the tenant, he pivoted,
All right.
sold his company, and moved into the real estate space and started Thor Equities. Uh, so that was back in the 80s. And then for the first 20 years of Thor's history, the company was focused predominantly on high street retail.
Okay.
So in the Sohos and Bond Streets and Champs-Élysées and Milan, all over the globe, we were, the high street retail players for the first 2 decades of the company. Then in the early 2000s, we pivoted and started investing in the hospitality sector in Mexico. We're the largest developer in the country of Mexico for hospitality. We built the Ritz-Carlton in Mexico City, the Montage. Now we're actually working on a Four Seasons hotel off the coast of Belize. So we do a lot in the hospitality sector in Latin America. Um, but that's a whole separate side of the
Right.
of the Thor umbrella. Um, Today, and so what happened was really the evolution of the firm over the last 10 years was we were in the high street retail space. A lot of the tenants that we worked with became close, clients, and the conversation was constant between Thor and the retail tenants. And what we were hearing from them was the onset of Amazon and the e-commerce, and they needed space for their omni-channel platforms. And they turned to Thor for um, to help them find logistic space outside of the cities that I had previously mentioned. So we began our Thor industrial platform in the mid 2010s, and then from that also thought about, well, the e-commerce space is affecting retail very strongly. How else could this kind of I guess, digitalization of the globe affect um, our current portfolio and just real estate in general? And that led us to start to invest in one, the knowledge economy space, so office that is more focused on tech and kind of shifting away from traditional office and more towards tech office, and then as well the life science sector, which as we've seen over the last few years and become more obvious
Yeah.
is resistant to the work from home and become more of a mainstay because of the fact that people have to be in person to do the science that's really driving a lot of progress around the globe.
Talking about life science, and actually, I mentioned during my introduction that that was going to be the main topic of today because I know Thor Equities has allocated a significant amount of capital to that sector. A lot of real estate private equity firms over the past couple of years have started allocating to the sector, which is really a niche. Can you explain us kind of this momentum behind the sector, as well as when and why did Thor Equities decided let's start allocating capital to that specific sector?
Yeah, yeah, so absolutely. So I think it's become such a um, hot and niche asset class over the last few years because of COVID. But what Thor saw before COVID, and also, what we've kind of just relied on, is that the funding and the increase in science and technology was inevitable, and COVID has essentially just advanced that very quickly. So venture capital from 2015 to 2020 going into the life science space was increasing, um, at a very hefty clip, call it 5% growth, compound annual growth rate. Um, and that was pre-pandemic. And post-pandemic, that's shot up exponentially and become a very, you know, um, well-known statistic, but Thor originally invested in life sciences back in 2017, when we took a few office spaces in the San Francisco area near Stanford and converted them from traditional office to medical office to life sciences. So it was kind of a strategy that we saw that, okay, like people weren't going into the office. Now's the time to make this move. So, um, what we see is that a lot of folks are kind of post-pandemic realizing now is the time, now is a great life sciences is a great asset class to get into, but pre-pandemic, all the same fundamentals were there.
Okay.
Investment in from venture capital was strong, but the other thing that was so strong was government funding as well, moving into the life science space.
Okay, so it's a sector that has started growing over the past 10 years, we could say. I mean, kind of like e-commerce, I would say. It's followed a similar path. And then with
Very
the
similar,
crisis,
very
it
similar.
basically just exploded. And so I'm sure if Thor Equities as well as many different other real estate private equity firms decided to get involved into this sector, is that there were value add opportunities to be made. You mentioned turning office spaces into a life science style of real estate. So I mean, what kind of value add opportunities can be found in this sector? And also, can you walk us through, for example, of the process of turning an office that's in a zoning office into a life science style of real estate?
Right, right. So one of the biggest value add opportunities is, like you mentioned, converting office or other asset classes. We've seen retail, old malls converted to life sciences and things like that, but office is the main one that we've seen. So the driver of the opportunity is twofold. It's one, you have tenants who are more likely mainstay going to be in the building for a long time. And two, just inherently, the value add is that life science tenants charge a higher rental rate. So, for example, we monitor closely the Washington, D.C. corridor, and rents are essentially double for life science tenants versus office. So, um, that inherently, if you're able to convert and bring in life science tenants, obviously it's a cost to convert the space, um, but just that long-term rental growth and as well just the initial bump is very strong. So, in terms of what's needed in the building to actually convert is such a widely discussed topic. And I think one thing that a lot of private equity and real estate shops that are getting into the space are realizing is that it's not easy, and you need to have very much the correct bones of the building to make it happen. So, um, I'm going to use feet just because I'm American, but for example, you need clear heights that are anywhere from 13 to 16-foot clear height, slab to slab, in order to have the right. So call it, 4 to 5 meters high. Um, you need to have floor loads that are able to withstand the weight of the material, the fume hoods and the benches and everything. So you need to have sufficient floor loads, and that's in, around 100 pounds per square foot. You need to have sufficient shaft space. There's a lot of air circulation additionally that's needed beyond the traditional office. So all these things, as well as freight elevators and doors to for shipping. So kind of all these things need to be present in order to for the building to even be considered for a conversion. And then once those are all kind of taken into account, you need to consider, is this the right location for a conversion? One
Right.
thing that's so present and important in life sciences is clustering. So life science tenants, more so than traditional office tenants, need to be in and around where other labs and other life sciences take place. So that's why, you know, when we are monitoring an opportunity and we're looking into the viability of a conversion, we also are considering strongly the location, which is obviously so important for all real estate, but so much more in life sciences. You need to be near other science that's taking place.
And what's the reason behind it? The fact that you have to be kind of in a cluster with other life science areas is because there's collaboration between different firms, or
Yeah, exactly. It's a lot of collaboration between firms. The other thing is that a lot of science relies from, one firm to the next as you're advancing. One tenant is going through trials and experimenting with something, and they're relying on the science from another nearby tenant. And as well, you also have a lot of collaboration just between scientists. Maybe a doctor is working with the drug company, and he needs to be able to come and check in weekly to see how things are progressing on their studies in order to advance his studies. So lots of collaboration. The other thing is that a lot of the science tenants that we have in our portfolio and see are they're spin-offs from one company to the next. Then
okay,
someone may leave a certain company and then start their own, but they don't want to move their whole family, so they stay in the same area. They just need new space, and that often will will take place. And then the other thing is that a lot of the space that tenants occupy is constantly changing in the sense that you have many stages of the research and development phase, and then also the development phase post research and development, where tenants may start out as a small tenant, maybe occupying 5,000 square feet, but as they grow, they get additional funding, they take on new scientists, and they need additional space. So much of life science tenancy is the expansion and the movement into additional spaces in the immediate cluster. So uh, they need to know that there is that optionality and that availability for additional lab space, and tenants really look to the landlords to make sure that they know what's required of um, what the landlord knows
all
what's
right.
required for the science to take place, so that they are in a environment that enhances their ability to grow as a company. So um,
And
for that, and then I will say co- one more thing. A lot of it is also that they need to be near the organizations that are, providing scientists
okay,
and funding. So, for example, Boston has become, well known, the number one science cluster in the world because of its proximity to top universities like MIT, Harvard. Um, so what we see is that a lot of the funding from these universities goes to these tenants, and then a lot of the scientists that end up working there go to these companies. So kind of in a little bit of a revolving positive cycle, we see how these clusters form and then become such mainstays because of their positive cycles.
and talking about the tenants, for example, let's take your portfolio, for example, in terms of the tenants that you have. Is it mostly nationwide, international tenants, or is it mostly, for example, startups, emerging companies in the sector?
There's certainly a range. For example, we have a portfolio in New Jersey, which is occupied by a large pharmaceutical company, very well known. Then we have um, a portfolio of assets in the Washington, D.C. corridor, which is more startup based, and it's all these smaller kind of footprints and tenants there, in the growth stage. And I think it kind of depends on what, as a landlord, as you're investing, when you're looking into, do I want to own life sciences, you have to take a second and think about the risk profile from the tenant perspective, because
Right, of
a lot
course.
of these startup tenants, while they do benefit from generally longer funding timelines than traditional tech startups. meaning that they have, a longer runway, so they have more money to pay rent for a certain amount of years. They obviously don't have the same credit as these larger pharmaceutical companies, be it Pfizer or Mercer. But with that said, there's also the opportunity for expansion with these smaller tenants, and they're quick. They're very quick to take up space. They need space immediately. They're willing to move in and spend money on the build outs. And generally, life sciences is um, a sticky space. So once they've built out the space to their requirements, they generally will renew and stay if their company is doing well. But you definitely do have to consider the credit of the tenants as they are often startups in the space.
All right. And so, of course, Thor Equities is invested in the US sector, but also you have a lot of capital, like you mentioned in the beginning of this interview, in the European sector. Talking about both markets, oftentimes when there is emerging trends, whether it be real estate, but also other industries, you tend to see disparities between both markets. Oftentimes, the US is leading the way by a couple of years, if not decades. So, I mean, do you notice any disparities between both market and what's your, thoughts on the supply and demand and the future expectations?
I think you said it perfectly, right? So we see often between the U.S. a little bit of a lag in terms of what kind of grabs hold in Europe. And what we've seen is that the U.S. Market for life sciences, while nascent itself, is well ahead of the European life science market, especially in some of these established clusters like Boston, I mentioned, or San Diego and San Francisco. But what we're seeing is that there's a huge opportunity in Europe. So Europe right now accounts for about 25% of global life science patents, which is, a significant amount. However, it accounts for only 14% of funding. So there is a kind of a misconnection between how much funding there is relative to the amount of science that's happening there. And I think what we'll see is that over time, increased capital will continue to flow into Europe. Perhaps not in the short term. Right now, Europe, the
Right,
sentiment
of course.
is generally across capital markets not at its peak. But what we'll see is that some of these clusters will emerge as the leading clusters across Europe, and there will be a massive flow of capital into these clusters as the science takes place. So one thing that we're following very closely are government fundings into the life science space. So we follow venture capital funding, also government funding. Um, and what we're seeing is that it's still early days with government funding in terms of life sciences has not caught up in Europe as to what it has in the US, but certain countries are making an effort to drive science and advancement. So we'll continue to see that in countries like Ireland and the Nordics, Benelux, so countries like that where um, we have nascent and kind of early clusters, but a lot of science taking place. There will be a massive movement of funding into those types of markets.
And so another sector you also invested quite amount of capital and you still are within Thor Equities is really the industrial and logistics sector, both in the US and European sector. Of course, I mean the logistic sector as an asset type really has grown significantly over the past couple of years, whether it be from private investors but also institutional investors that invested capital where 10 years ago you only had small private investors investing in that sector. So what's your sense on that market today, and do you believe it will remain? It will have the same momentum and growth that it had over the past couple of years? What's your thoughts on it?
I think for both the life sciences and industrial sector, we're going to see a little bit of a blip and in terms of like a slowdown in terms of growth for the time being, and that's just naturally with the cyclical nature of capital markets. We're kind of in the downturn, but the underlying fundamentals for both the industrial and life science sector remain very strong. Um, I think one thing that we've heard from folks is, well, maybe cap rates or yields will move back to pre-pandemic levels that we saw in
Right.
2018 and 2019. And I think for multiple sectors, maybe for retail, for office, and perhaps multifamily, we'll see that. But I think for industrial and life sciences, I think we can expect that these sectors have changed for the long run. And I think a lot of it has to go back to what's going on with the deglobalization of the world and kind of the change in supply chains that we've seen. These are sustained changes that, likely will stay and last for a while. So while we can expect there to be cap rate expansion and yields to kind of, move with the capital markets and move with the debt shifts, I think the underlying fundamentals for both industrial and life sciences remain very strong. In industrial, we are seeing continued rental rate growth across the markets that we cover, and I expect that to continue. And the one thing that I will say about the way that the debt markets have moved, it's become increasingly difficult to make deals pencil and to get
Right, of course.
land at a cheap enough price to make development make sense. So what we're seeing is that there's been a slowdown in terms of developments, in terms of new product that's going to come online over the next few years, but there hasn't been the same shift or kind of slowdown in terms of demand. So what we're likely going to see is that rental rates will continue to grow because the demand is staying strong while supply is coming down. And as we come out of this downturn, whether it be 2024, 2025, um, the investors will jump back in and try to pick up where once deals start to pencil again and try and catch up and account for that that increase in demand.
And within Thor Equities, when
I
it
think
comes to industry, go ahead,
Yeah,
go
what
ahead.
I was going to say is I just wanted to touch on the deglobalization piece is that it affects industrial as much as it does in life sciences. So what we've seen is that countries are looking to become more self-reliant as they turn away from developing things in China and in Russia and areas like that. But um, that affects industrial and life sciences because on the industrial front, we see a lot of the Buy America program, and I think the same will happen in Europe where they want to make things in America. And from the drug perspective in life sciences, it's going to be the exact same thing. So both affected positively by the as in Europe and the U.S.
So both really following similar trends. And so,
Yeah, I
talking
think
about,
continued growth in both.
and talking about, Thor's equity involvement in industrial real estate, what's your, current investment mandate into that sector? Are you looking for value add opportunities, potentially reconversion? Can you walk us through a little bit?
Yeah, so we have um, capital allocated for core plus all the way through development. So we have a couple different mandates on the core plus side, looking for, well located, strong cash flowing assets. Um, on the value add front, we're doing a good amount of I would say kind of improvement of sites. So a lot of what was built, in the 70s and 80s is very high coverage, doesn't allow for great flow through of the building. Maybe we need to raise the ceiling heights or certain things like that. So looking for value add that's going to be able to to make space more functional. And then on the opportunistic front, looking to really develop from the ground up. And I think the one thing where we're really hyper focused is being infill, being really close to um, ports, intermodals, really close to the cities. Because I think one of the risks of industrial is oversupply, and you need to be in a place where there's some type of supply constraint. So that's why we really try and target those infill markets.
So really urban kind of industrial logistic, while of course keeping the transportation perspective in place because it's all about being strategic from a transportation perspective, and of course you're involved a lot into capital markets. And the next subject I really wanted to touch on is kind of shift. In capital allocation, we've seen a lot of fund managers, a lot of funds of funds, family offices, institutional funds, allocating more and more capital to private equity in general, and of course, real estate private equity. Many factors contributing to it. We've seen the public market being very volatile over the past couple of years. When you look at public REITs, sometimes the net asset value and the actual market cap doesn't really match, which can be a hassle for investors looking for more sustainable long-term investment. So I mean, of course, I'm guessing within Thor Equities, you talk with LPs on a weekly, if not daily basis. So, from your perspective, do you see that happening?
Yeah, I think we've seen that for, call it the last year and a half, 2 years with, firms increasing their allocation to real estate and increasing their allocation to the private sector. I will say over the last, call it month, the conversations we've been have, some LPs are looking at the public equities with an eye that, maybe there's an opportunity to pick up some things at a discount. But with that being said, I think that's more of a, right now is a good time for discounted public equities, but the long term, they're looking at to the private side, to private equity, to real estate for those exact reasons that you mentioned. You have more um, kind of stability and sustained growth, and you're not so susceptible to kind of the shift of kind of global sentiment and things like that, where you actually, if you believe in the long-term fundamentals of the real estate that you hold, if you believe in the markets that you're covering, then you're not worried when things kind of, oh, there's so much uncertainty in a time like this. And I think now, while there is good opportunity to pick up public equities at a discount, I think long term, the real estate sector and private equity is is going to be a beneficiary of, the increased attention and kind of, and as people continue to follow, there'll be more investment in both those sectors.
And of course, talking about capital markets as well, we see a lot of things happening on the macroeconomic level between the fact that, we're still in an inflationary environment, whether it be in the US or also in Europe. We see central banks are really trying to fight it by, raising rates and consequently causing a recession in some cases. We see economic uncertainty due to factors such as supply chain disruption. We still see, labor shortage going on in many industries, such as hospitality, for example. So, what is the current view and within Thor Equities from a macroeconomic perspective? Has your investment thesis changed a little bit? Have you guys made any changes in kind of the deal underwriting process?
Yeah, I mean, we're constantly recalibrating our investment strategy and our thought process. But what we do know is that real estate performs well in an inflationary market. And I think as long as the Fed and kind of the rates and inflation right now is a good thing for us. As the rates rise, I think we'll continue to see a slowdown in just
Right, of
capital
course.
markets activity, and LP sentiment has kind of become more of a negative outlook. But for us, that provides an opportunity. As a lot of people are on the sideline, we're still out there transacting. We're looking to pick up opportunities now at a discount. So I think one thing that we do know is that real estate fundamentals remain strong. Inflation will actually continue to drive rent. And as we find some situational distress in the market, I don't think it's actually asset distress. The asset level distress is not really there. The assets are still performing strongly. It's situational distress, maybe from someone, a developer is spread too thin, or someone, didn't put caps on their floating rate debt or things like that, where perhaps there's some distress in the market and we'll be able to pick up opportunities while others are on the sideline. So overall, yeah, definitely, understanding that the uncertainty can um, cause some people to just kind of wait on the sideline. We're looking to pick up opportunities in their absence.
I think one of the main issues faced by private equity and real estate private equity in this time of age, with central banks really raising rates on a pretty consistent basis, at least this past couple of months. Who knows what the future will hold, but most likely we will see, rates still going up to kind of fight inflation. One of the hardest thing is during the underwriting process is really coming up with exit yields. So how do you
Mhm.
manage that within Thor Equities? What's your process on that?
Yeah, it's a good question, and I think one thing that we're constantly trying to, discuss is exit cap yields. Where are things trading? So we're obviously playing a few different geographies, a few different asset classes, and we're constantly monitoring and tracking all of this data as best as we can. Um, what we've seen over the last, call it since, 4 or 5 months, 6 months, is yields move out, exit cap yields move out, call it 50 to 75 basis points in the industrial sector, and in the same for the life science sector. Um, So, uh, are we done there? I don't think so. So we're building in a little bit of cushion beyond that. And what we what we talked about earlier about, perhaps yields, exit cap yields move out to where they were pre-pandemic. There's always the chance that that happens, but we believe in the long-term fundamentals and that the reality of the world has shifted from the pre-pandemic times. The pandemic obviously shifted a lot of how the world operates in general. So using our best to track data, having conversations about where we see the demand following this downturn and trying to position ourselves best and find deals where we're buying at an attractive enough basis where even if yields are to push out, exit caps or continue to move out, we still feel good about the real estate that we hold. So I'd say, constantly just tracking data, having conversations with brokers, with LPs, and just trying to stay in tune with the market.
So buying at the right price, at the right location, and also in the right asset type. Is that correct?
That's the dream, right?
Perfect. Well, exactly, it is. Well, thank you for this interview and kind of this knowledge. I think a lot of knowledge around, life science, around industrial sector. Life science is a sector that has grown over the past couple of years. Hopefully we'll have the chance to have you on again, maybe talk about other sectors. I know you're also involved into data centers, but sadly we can't talk about every sector within an interview. Before we wrap up this interview, I mean, is there anything else you want to mention? You want to touch on that we maybe haven't touched on?
I think just before we go, one thing that came up that I just thought of in terms of the life science sector is a shift towards kind of the meeting of industrial and life sciences, which I'll call good manufacturing practices, GMP. And I think we're going to see a lot more of that. That's going to become increasingly popular. So just keep an eye out for GMP, kind of the intersection of life sciences and industrial, which is a space that we're looking at heavily.
Perfect. Well, thank you, Jeremy, for coming in this great interview and talking a little bit about Thor Equities, life science, and the different topics we mentioned. Guys, you can listen to this interview on our website, on our app. That's free to download both on the App Store and Android. And talk to you soon.
Thank you so much for having me.
You're welcome.
Talk soon.